Okay, welcome to the deep dive.
Good to be here.
So you've handed us quite a bit of source material focused on one particular investment product.
hmm
And our mission, well, it's pretty straightforward. Cut through all the noise, really dig into those pages you gave us.
Yeah, pull out the really important stuff, the key insights, maybe some surprising facts for you.
Think of us as your guides for this specific material, helping you navigate it without getting bogged down.
We're just highlighting what jumps out, how things connect, and, what it all really means according to these documents.
Absolutely. So today we're tackling the ICICI Prudential Bharat 22 ETF. And just to be clear, everything we talk about is based only on the sources you shared.
Right. And they give us a pretty detailed picture, the fund's structure, what's actually inside it, performance figures, risk stuff. It's all in there.
Our goal is just to walk you through that information, make sure you leave with a solid grasp of what your sources are saying about this specific fund.
Okay, let's do it. Where should we start?
Let's unpack the fundamentals first. What the thing is. The material says this ETF launched back in 2017.
Yep, 2017. Trades under ICICI 22. And the volume, according to recent data in there, is around 19.87 lakh units.
Okay.
Now, structurally, the key thing is its category. It's labeled as a large cap EPF.
Large cap. So holding mainly big company stocks.
Exactly. Primarily stocks from those large cap companies.
Yeah.
Its benchmark is the BSE Bharat 22 Total Return Index.
Total return index. That's important, right? Because it includes dividends.
Precisely. It accounts for dividends being reinvested, so you get a fuller picture of the benchmark's performance when you compare.
Got it. And the size, AUM.
The fund manages a pretty substantial amount assets under management, or AUM. Your sources put it around 904 crore.
Okay, 904 crore. That's pretty significant for this category.
It suggests it's a notable player, yeah.
Right. And one of the first things that really jumps out from the sources is the risk level they assign. It's clearly marked very high.
Stark label. Interestingly, though, no exit load, which is, typical for
The
ETFs.
standard stuff.
And the expense ratio is remarkably low, just 10.07%.
Wow, that is low.
Very low. That's kind of a hallmark of these passive funds tracking an index.
And it focuses, as the name suggests, on just 22 stocks.
22 specific stocks, yeah. The sources also name the fund managers, Ajay Nishit and Priya Sridhar.
Okay.
And if you look at what it holds, it's about 99.5% in equity, sticking to those large cap companies we mentioned.
The current price listed is around 188 rupees. And of course, taxes. The sources outline the usual short-term capital gains if you sell within a year.
Right, and then a 10% long-term capital gains tax after holding for a year. Pretty standard for equity investments in India.
Okay, so that gives us the basic framework, the foundation. Now,
Yeah.
how has it actually performed? Because the numbers in your source material look, well, pretty compelling.
They certainly do.
Yeah.
Especially when you line them up against the average large cap fund. The differences are quite striking.
Okay, like how?
Well, looking short term first. Over the last 6 months, your sources show this ETF returned 27.29%.
27%. And the average?
The category average was 21.30%. So a noticeable lead already.
Just 6 months, yeah.
Absolutely. But it gets even more pronounced over 1 year. The sources show a massive 73.2% return for the ETF.
73%? Wow.
While the average large cap fund was closer to 39.56%.
Huge difference.
It is. And the ETF's rank reflects that. It was 37th out of 156 funds over 6 months.
Okay.
But it jumped to second place out of 150 over the last year, according to these numbers.
Wow, second place out of 150. That's seriously impressive based on this data.
And the longer-term picture seems to reinforce it. Over 3 years, the ETF showed an annualized return year-on-year of 42.2%.
42% annualized compared to,
Compared to the category average of just 18.87%.
again, a massive gap.
Significant outperformance. And looking back 5 years, it was 26.2% annually for the ETF versus the category's 15.26%.
So the sources clearly paint a picture of consistent, substantial outperformance relative to its peers over these periods.
Absolutely. That's what the numbers in the material show.
And to make these returns a bit more, tangible, the sources give some potential growth figures, like a 1 lakh lump sum investment.
Right. They show it could potentially grow to around 1.7 lakh in 3 years, maybe 2.3 lakh in 5 years, and about 5.5 lakh over 10 years, based on that past data, of course.
And they add a layer of realism, too, don't they, with inflation?
Yes, importantly, they provide an inflation-adjusted future value. So that 5.5 lakh after 10 years. They estimate it would feel more like 3.1 lakh in today's purchasing power.
That's a really useful detail to include.
Definitely grounds the expectations.
They also model SIP systematic investment plans, a 5,000 rupee monthly SIP.
Could potentially reach 2.4 lakh in 3 years, 4.8 lakh in 5, and maybe 16 lakh over 10 years.
And the inflation-adjusted value for that 16 lakh.
Estimated around 9 lakh in today's terms.
Okay. There's another SIP scenario, too.
Yeah, a smaller one. A 2,500 rupee Heisai, but increasing by 10% each year. That could potentially hit 1.3 lakh in 3 years, 2.8 lakh in 5, and 11.2 lakh in 10 years.
And adjusted?
About 6.3 lakh in today's money.
And the sources mention another way to invest, right? An alternative.
Yes, they point out there's an ICICI Prudential Fund of Fund, an FOF, that basically just holds this ETF.
Ah, so like investing indirectly.
Exactly. It could let you invest via ICICI without needing a DMAT account.
Yeah.
The brokerage account you usually need for ETFs.
But there might be a catch.
Well, the sources suggest it might come with a slightly higher expense ratio than buying the ETF directly. Something to check.
Okay, so those performance numbers, especially stacked against the category average, they're undeniable based purely on the data provided here. But, as we know, great returns aren't the whole story. What about the risk side? How does the analysis look in your sources?
Right. This is where it gets particularly interesting, especially trying to square those high returns with that initial very high risk label we saw.
Yeah, how do those fit together?
So your sources look into several key risk ratios. First up is beta. It's listed at 0.9 for the ETF.
0.9, and the average?
Category average is 1. Now, beta measures how sensitive a fund is to overall market moves.
So below 1 means?
It suggests this ETF has historically been slightly less volatile relative to the broader market, or maybe its benchmark, than the average fund in its category.
Okay, that sounds positive on the volatility front relative to the market anyway. What about the Sharpe ratio?
Exactly. Sharpe measures risk-adjusted return. Basically, how much bang for your buck, risk-wise.
And the numbers.
This ETF has a Sharpe ratio of 2, according to the sources. The category average is just 0.9.
2 versus 0.9, that's a big difference.
That's significant. A much higher Sharpe ratio, like the sources show here, means the fund delivered substantially more return per unit of risk taken compared to its peers historically.
And does the Sortino ratio tell a similar story? It looks at downside risk, right?
Yes. Sortino focuses specifically on downside volatility. The ETF's Sortino is 3.9.
Okay. And the category?
Category average is 1.7. So again, a much higher number.
Implying what?
It implies, based on this data, that the fund has been more effective at handling those downward market swings relative to its returns compared to the average fund. So yeah, looking at beta, Sharpe, and Sortino, the picture seems pretty favorable in how the fund managed risk relative to returns and peers in the past.
But there's a point of contrast mentioned in the sources too, standard deviation.
Right. Standard deviation measures the overall volatility of returns, how much the fund's own returns have bounced around its average.
And for this ETF?
Its standard deviation is 15%. The category average is 14%.
Ah, so slightly higher than average.
Exactly. So while the beta suggests maybe lower market correlation, the standard deviation indicates the absolute swings in its own returns have actually been a bit larger than the average large-cap fund.
That's a subtle distinction.
It is. It's nuanced, potentially less sensitive to the market's direction, but with higher volatility in its own results.
The sources also mention a low portfolio turnover ratio, around 3%.
That makes sense. It's consistent with a passive ETF structure. Low turnover means it isn't constantly buying and selling stocks.
Which keeps costs down?
Keeps costs down and helps it track its index closely.
Okay, so let's try and piece that risk picture together from your sources. We have favorable Sharpe and Sortino ratios, suggesting strong risk-adjusted returns and better downside management relative to peers. A beta below 1 suggesting slightly less market sensitivity,
Right.
but a slightly higher standard deviation indicating more overall volatility in its own returns.
Yes.
And all this is under that umbrella label of very high risk for the fund overall.
It creates this fascinating picture, doesn't it, where past performance and certain risk ratios look exceptionally strong compared to peers.
Yeah.
But the fund itself is still categorized as very high risk. And that really makes you wonder why, which brings us to what's actually inside the fund, the holdings.
Okay, right. Let's talk about the holdings then, based on the source material.
So as we noted, it's about 99.5% equity. Looking at market cap, it's heavily, heavily skewed towards large and giant cap companies.
How much?
They make up around 93% of the portfolio value, according to the sources, with only about 7% allocated to mid-cap.
93% in the big guys. And the sectors.
Your sources list the main ones as energy and utilities, financials, industrials, consumer staples, and materials.
Okay. Any standouts there?
Energy, financial, and industrial sectors seem to contribute the most to the fund's value, based on the breakdown provided.
Now, here's where that very high-risk label probably comes into sharp focus, right? Concentration. It holds 22 stocks total, but...
Yes, and your sources are very specific about this concentration. They state the top 10 holdings account for 83% of the fund's value.
83% in just 10 stocks.
And then they actually refined it slightly, saying the top 10 to 12 stocks hold approximately 84% of the fund's value.
83 to 84% of the entire fund, packed into just 10 or 12 companies. That's a huge concentration risk highlighted right there in the sources.
It really is. The top 10 names listed are ITC, L&T, NTPC, Power Grid, Axis Bank, SBI, Indian Oil, Reliance Industries, ONGC, and BPCL.
So the performance, the volatility, everything about this ETF is heavily, heavily tied to how those specific companies do.
Absolutely. That level of concentration, while it might explain some of the impressive historical performance, if those specific stocks did exceptionally well.
Right, if you pick the right winners.
Exactly. But it inherently carries a higher risk factor compared to a fund that spreads its bets more widely. The fund's performance becomes very sensitive to anything happening with just a few of those big names.
Okay, so we've taken this deep dive, guided entirely by your source material. We've looked at the basic structure, the low cost,
The fundamental.
the really exceptional performance numbers relative to the large cap category across different time frames shown in the data.
Yeah, striking differences there.
Then the risk ratios, Sharpe and Sortino looking quite favorable, beta slightly below 1, but standard deviation a bit higher.
A mixed but interesting picture on the ratios.
And finally, the holdings. The sector focus, but crucially, that very high concentration in just a handful of stocks, all sitting under that very high risk banner.
And breaking down the source material like this, it really lets us see the specific numbers, the comparisons they make, things like the potential impact of inflation, even practical details like that FOF investment route.
Right.
The overall picture painted by your sources is of an ETF with, good size, good trading activity,
Okay.
exceptional historical returns, and favorable risk-adjusted metrics like Sharpe and Sortino,
Right.
but balanced against that explicit, very high-risk designation and, critically, that significant concentration in its top holdings.
And as always, we have to remember investing involves risk. Everything we've talked about today comes straight from the source material you provided. It's intended purely to help you understand what's contained within that material.
Definitely. And maybe here's a final thought, drawing directly from those details in your sources for you to chew on. Given that the sources explicitly state 83% to 84% of this fund's value is packed into just its top 10 to 12 stocks,
Yeah.
what are the potential consequences for its future performance and risk if maybe just one or two of those specific companies, those big names we listed, run into significant trouble? Maybe individual company problems, regulatory changes, a downturn in their specific sector. How does that intense concentration, which the source material clearly highlights, weigh against the fund's very impressive past performance numbers when you think about this investment going forward?